good morning, everyone. Actually, there's a lot more of you out there than I thought, given the events that we all wondered about. And indeed, I think we have to rethink the polling industry and their methodologies, given the emotional and behavioral aspects of voting. But that's not my specialty, but it certainly was one that we were concerned with. And it's actually very nice to be not in the United States today. I must say, even if it is raining here in London and it's been quite cool, we've really enjoyed coming here a lot. And I'm absolutely delighted to be working with S&P Global, which many of you know is the new name of the Standard & Poor's organization, and particularly with the risk group within Global Market Intelligence, headed up by Martina. And finally, to work with Cristiano. Where are you, Cristiano, anyway? There on the end. In many ways, partnerships are very interesting, especially when you try to have several dimensions to that partnership. And I've always found over the years that the most rewarding one from an academic standpoint is when we hold certain events like conferences or seminars like this, where we combine the academic and the quote real world elements to the subjects that we're talking about. And we had an incredible conference in New York last May on credit markets, bringing together those parties as well as regulators and other government organizations, representatives. So it's been a great partnership, and we hope to continue it and get the local flavor as well as the global flavor on this. So the topic for today, you can read it there. It's in your notes, and you have a lot of slides. I won't have time to go through all of them, but hopefully you will have time to reflect on them after today, and certainly we're interested in communicating with you on those issues if you have an interest. Where we are in the credit cycle, and is there a bubble building in the corporate and sovereign credit markets? This has been a subject that I've been studying one way or another for about 100 years. You're supposed to laugh when I say that, but it has been a long time, and we're approaching 50 years on Z-score. It's always very interesting and very easy for me to remember how many years I've been married, because I built the Z-score model 50 years ago, and I also got married 50 years ago. So it's very easy to remember that, plus my first and only job I got 50 years ago. So it's pretty easy, and we'll be all celebrating 50 very soon. And actually, I'm going to talk a little bit about that in my discussion of the fundamentals of credit. One thing that I've always embraced, despite events that may shake that up, and there have been a lot of them lately, is fundamentals of credit. And so maybe some of my approaches might be considered old-fashioned, as you'll perhaps think today, but let me try a sports metaphor with you to illustrate where I think we are in the credit cycle. About a year and a half ago, I began to think about this subject, write about it, and speak about it in various venues about the credit cycle. And it's not the first time. The last time I remember doing it very carefully was in winter of '07, about a year before the financial crisis, the big financial crisis of late. And And then we predicted that there would be dramatic turmoil in the credit markets. And I was particularly interested in the corporate market, a little less so at that time about the sovereign market. And we predicted in winter of '07 that there would be somewhat of a dramatic event or a series of events which would result in what we call a financial crisis in credit. And we were right, but it turned out we were not right about what would be the catalyst, which turned out to be the mortgage-backed securities market, of course, rather than the corporate debt market. But we drew upon, then, fundamentals. And so I'd like to compare this morning, as much as I can, with you, the similarities and differences between 2007 and 2017, coming up, 2016 today. But a year and a half ago, when we began to think about this, I used the metaphor, and you'll have to excuse me for a moment if I refer to a sport that you're not familiar with called baseball, but I'm going to try to localize it and talk about football as well. And I'm talking about your football, not our football. But I was very interested to see how popular our football seems to be getting to be, at least in London, on some events. We have professional football games. But a year and a half ago, we thought that we were in the 70th minute of a European football game, meaning that the game was getting close to being over with respect to the benign credit cycle. And I'll define what I mean by the benign credit cycle quite carefully with you in a moment. And that was about a year and a half ago when I gave a speech for a group called the Turnaround Management Association in New York in February of 2015. So we thought the game was going to continue, the benign cycle of low default rates, high recovery rates given default, yields and spreads that were relatively low, and lots of liquidity. So if we wanted to define a benign cycle or a stress cycle, I like to talk about these four metrics: default rates, recovery rates if there are defaults, yields and spreads required by investors in a market, and liquidity. Now, my background in credit is in many aspects of it, but the one that I draw upon to talk about the cycle is the so-called high-yield bond market, or the junk bond market, which, of course, has only existed in relatively modern times for about 40 years, maybe less. And I had the good fortune of being at the beginning of this market from an academic standpoint in the early 1980s, when that market began to develop in the US and, of course, spread elsewhere since then. And so when we refer to default rates, recovery rates, spreads, and liquidity, I'm going to refer to both the US and the European high-yield bond market. And so a year and a half ago, we were in the benign cycle, low default rates, high recovery rates if there are defaults, low spreads, and lots of liquidity. And that was a pretty long period of that since 2009. Fast forward to the beginning of this year, January, February in particular, that same group, we extrapolated on that metaphor and said, for baseball, we were in the 9th inning, which is right at the end of the game, and for football, in the 89th, 90th minute. In other words, we were fairly convinced that the benign cycle was coming to an end around January, February of this year. The only variable of those four that was not in a stressed cycle, which is the opposite of the benign, was default rates. They were still relatively low, even though they were beginning to rise in the US. and I'll show you that right now. Here, by the way, are the standard nomenclature. So we're talking about the high yield or junk bond market below BBB minus SP ratings. We won't mention the other rating agencies, but there's been a lot of studies talking about investment grade versus high yield. And of course, investment grade is very important because the size of the market. In the US, we think that the corporate bond market is about $7.5 trillion. I'm not even sure what it is in Europe, but you can perhaps tell me that. The US high yield market, about 1.7 trillion. I would guess in Europe, we're talking about between 5 and 600 billion euros. So about 1/3 of the US market, but much higher than it used to be. And I'll show you that more clearly in a moment. So US high yield, 1.7, European 0.6 billion, 0.6 trillion, 600 billion, in that range. South America, about 150 billion, Asia, about 125 billion. So it's a pretty sizable market globally, smaller than the investment grade. But if you take out financials from the investment grade market, you're dealing only with industrial companies. High yield is every bit as big, if not bigger, than investment grade. And new issues are very large and have been for many years. There's the breakdown if you were interested in. This is the trend of the growth of our high yield market. So we began back here in the early 80s, 10, 12 billion, all fallen angels. Beautiful at birth, but like many of us, as we get older, we get uglier, like companies sometimes do, and we get downgraded to non-investment grade, and that means the market grows from that area as well as new issue high yield, which of course is the main reason for growth, and you can see that as the growth went up to 1.6 trillion. Default rates, the first of the four variables. Where are we now in the US and in Europe? Well, as of the 25th of October, when we put together this PowerPoint slide, we were at 3.9% default rate year to date in 2016. Historic average annually 3.6%. So for the first time, and you can look at this actually on this graph, for the first time since the end of the financial crisis of, I don't know if you can see this or not, I can't see, there you go, I can barely see it and I'm about 3 inches away. But since the first time since the end of the crisis, which is around 2010, 2009 and 10, the default rate on a last 12-month basis, for the first time here, is above the historic average. Now that's the US, mainly driven by oil, gas, and mining companies. About 70% of defaults in the last year and 2/3 are from oil, gas, and mining companies. Since you don't have that industry in turmoil in Europe, the European default rate, you'll see, is going to be much lower. But for the first time, in the beginning of this year, and certainly now, the first metric in our definition of a benign cycle, default rates, is now above the historic average. Now, what does going above the historic average mean about potential financial crisis going forward? Well, there's another graph that I think is even more instructive. This graph shows you the relationship between default rates and economic recessions. These are recessions in the United States. We're very fortunate in the US. We've had lots of recessions, lots of bankruptcies, lots of defaults. And when you have a lot of data points, it's much easier to build models, to understand relationships between that variable and other variables in order to learn what's happened in the past, about what's happened in the past, to give us guidance for the future. And what you might notice, particularly in the last 3 stress periods in the United States, and I'm talking about 90-91, 01-02, and 08-09. The last 3 times we've had a 10% default rate, which is our definition of a stressed default cycle. 2 standard deviations above the mean of 3.4%. In each case, the default rate started rising 2 to 3 years before it hit its peak. So you notice that in 1991, it actually started going up in 88 and peaked just after the recession ended. In 01-02, it started 3 years before, in 98, 99, 2000, and then peaked in 2001, 2002. And the most recent one, a little different because the default rate started going up, but more in the mortgage-backed structured finance industry, residential mortgage-backed, and then in corporates. Corporates caught up and peaked right at the end of the recession. So this is very important for understanding stress periods, because even though we may predict the beginning of a stress cycle starting, for example, next year, which is what I believe, that doesn't mean it will end up in a crisis. And the crisis is where essentially credit is incredibly expensive, liquidity drops dramatically, spreads increase dramatically, and recovery rates drop dramatically. So those are the 4 metrics again. The point I want to make is we will not have a financial crisis in credit unless we also have a recession. So even though the fundamentals of credit, which I'm going to argue, have deteriorated quite a bit, at least in the high yield market, and we will see whether or not they are similar or not to 07, I'm not predicting a financial crisis in credit unless we also have an economic recession. It doesn't mean that we won't have higher than historic default rates, which we already have, as you notice in the right-hand corner of this graph. Again, driven mainly by one industry. So maybe one thing we can discuss in the Q&A, how important is it to include or exclude data about a big distressed industry like high-yield energy and mining company? Incidentally, for your information, energy comprises about 18 to 20% of the high-yield market, all right? So if it's 18 to 20% of the high-yield market, and you have a very high default rate, something like, I think the Standard & Poor's team in this area estimate that the default rate on energy companies in the U.S., if you include oil, gas, and mining, is about 25%. 25% of the industry is in default. But here's the irony, and I've seen this 3 times in history. Sometimes you have a period when the default rate escalates dramatically, whether it be for the market or a particular industry, in a particular year. 1991, 2002-03, and again this year. And at the same time that the default rate is escalating, and you would think this is a risk-on situation, the rate of return on investing in risky debt is astronomically high. And so we can learn that in some cases, there could be an escalation of risk. and it will be the opposite reaction to investors in those securities. And it has to do with expectations. For example, the return on high-yield bonds in 1991 was around 45% positive. And 1991, if we go back, 1991 was the first time we hit 10% or higher default rate. But the return on risky debt was close to 50%. In 2002, the return was even higher, and in 2009, when the default rate went to 11%, the return was 60% on high yield, 90% on distressed debt, and 120% if you invested in somewhat of a niche industry called defaulted bonds, the so-called distressed investment industry, which I've had a lot of contact with over the years because, I hate to say it, and I apologize, I get really turned on by bankruptcies and defaults, and it is a sector, if you understand it, and it's not easy because it's a very complicated one to invest in, it can have astronomically good returns. And one of the things we've learned is that if the market expects extremely high default rate, like it did in 2009, all of the rating agencies and us to some extent were predicting anywhere from 14 to 20% default rates in 2009. The actual default rate was 11%, less than expected, and the market boomed. So it's not only how high the default rate is, it's how high the market expected relative to what turns out to be the case. And this year, remarkably, the return on risky debt is extremely high. High-yield bonds are earning about 17% year-to-date, 1.7. Distressed debt, let me define distressed debt for you. That's bonds yielding more than 1,000 basis points over treasuries. Distressed debt this year earning close to 50% from the beginning of the year to now. And from February, probably 70%, because it was down 10, 15% at the beginning of the year. And defaulted bonds, we have an index at the Stern School that we calculate. We've been doing it since 1987. It's the return on defaulted bonds and defaulted loans. This year, the return on defaulted bonds, I just got the data yesterday, 65%. Now, you might ask the question, how could the returns be so high in a somewhat stressful year as far as defaults go in really risky debt? And this year, the reason has to do with the price of oil. The price of oil has gone from the low 30s to what are I guess around $50 a barrel. I've been traveling for about a week, so maybe it's a little higher or lower, but let's say 50. And that means the recovery rate expected on a default has actually gone up a lot, because the recovery rate has had a lot to do with the security behind the company's performance. So let's keep that in mind when we talk about the implications. At the beginning of this year, all of us predicted default rates higher than the historic average. Fitch being the highest, we were second at NYU, and Moody's and S&P somewhere in between. But all of us expected higher than the historic average. So the first metric of the four, everyone is expected to be higher than the average, meaning we may be going into or leaving the benign cycle. Let's talk, here, by the way, are European high-yield bond default rates. And you could see that this is by issuer. You could see that the default rates have been low since 2010, and much lower than the US, 1.2, 0.9. So ironically, my American colleagues can't figure this out. I'm not sure I can. Why is the European high-yield bond rate, given Europe's had a lot of financial problems, certainly since 2008, lower than the US? And I think it has to do with a couple of things. One is the makeup of European high yield is not nearly as dominated by oil, gas, and energy. And second, let's take a look at the breakdown within the high yield market, double B, B, and triple C. You'll see that the European market is far more conservative than the US. And that's, by the way, the reason, and this is really striking. I don't know if any of you really follow this market here, but if you do, you notice that the spread, required rate of return of high-yield bond investors in Europe is about 100 basis points lower than the US. Historically, up to last year, it's about 100 basis points higher. So there's been a huge swing in the required rate of return of investors in high-yield bonds in Europe versus the US in about the last 14 months. And it surprised a lot of people. But I think there's some good reasons for it, as we'll explore when we take a look at the structure of the two markets. Here is the breakdown by issuer. Sorry, the other was by dollar amount. This is by issuer. A little higher. Year to date, for the last 12 months in Europe, about 1.9%. The US about 3.9%. So we're talking about 2% higher than the US than in Europe. Let's talk about recovery rates. And this is very instructive, I think, about understanding this market. And by the way, it goes beyond high-yield bonds. If any of you are familiar with the credit default swap market and how that works, you know that one of the key variables are recovery rates. You'll get a very different risk exposure in markets when recovery rates are expected to be high versus low. Historic average on bond recoveries, this is bonds, not loans, around 46 cents on the dollar. This is measured based on the price of the bonds just after default. The CDS market measures it 30 days after, and many of the banks and some of the rating agencies like to talk about ultimate recovery. That's at the end of the restructuring period. I take the easy way out by looking at market prices just after default, 46 cents on the dollar, historic average. So that's here, with the weighted average default rate on average around 3.4% a year. So let's look at 2014. Low default rate, 63 cents on the dollar recovery rate, very high, and indeed, that's what you would expect. When you have low defaults, you have high recoveries usually. The two are very heavily negatively correlated, as given by our regression analysis in this area. I don't have time to go through this in detail, but we've published this work ever since 2005 with a couple of Italian colleagues. And it's very clear that when you have low default rates, that's down here, you tend to have high recovery rates, that's on the y-axis. And vice versa, when you have high default rates, you tend to have low recovery rates. And so in 2014, we had relatively low default rate, very high recovery. 2015, default rate was going up, still below historic average. Recovery rate overall, 34 cents on the dollar, less than the historic average, but it was mainly because of energy and mining, and the price of oil was low. Fast forward to today, year-to-date, 3.9% default rate, for the first time above the historic average, but extremely low recoveries, 28 cents, 27 cents for mining, all other 36 cents, all below the historic average. Something's going on. Why, structurally, do we find not very high default rates and recovery rates are very low? And that is the second metric in our four metrics about the benign credit cycle. So I'm concluding that, one, default rates are high and recovery rates are low, 2 of the 4 pointing to the end of the benign cycle. We're in the 90th minute of the football game, but we forgot one thing. The score is tied in the game. And you know very well when the score is tied, you have extra time. So let's explore what does extra time mean for the financial markets. Well, in February of this year, the 4 major central banks of the world, European, Fed, Bank of Japan, and the Bank of China, all decided to up the ante with respect to liquidity and pumped enormous amounts into it, including buying corporate bonds starting here in Europe. And when you buy corporate bonds, even if it's just investment grade, that's an artificial demand source. Prices will rise vis-a-vis what normally would have been the case. Spreads will fall. And that's one of the reasons why spreads have fallen so much in the European high-yield market as well as investment grade. The other reason, I think, is structural more, and that is with respect to conservatism. So central banks pumped money into the system starting in February, March of this year. Second, the price of oil started going up. Very important to the U.S. market because that impacts recovery rates. Third, China calmed down. I don't know why it calmed down, to be honest with you. This happens all the time, up and down, because the data coming out of China is highly questionable, and maybe when you get no data. But let's face it, and we can talk about this in the Q&A, China is a big, big factor this time compared to the past as to its impact on credit markets. And China's enormous increase in debt, particularly in the shadow banking area, is very worrisome, which we'll come back to that. So 2 of the 4 pointing to a stress cycle. Let's talk about, there's a lot of data here on our mining and energy industry. It probably is less relevant for you folks, but very relevant for us. Spreads. This is the yield spread in the U.S. high-yield market between high-yield bonds and 10-year treasuries. It's also the option-adjusted spread. They're very similar. Notice that in 2007, we were at 2.6%, the lowest in the history of mankind. We like to dramatize credit markets, we call it mankind. But it was very low. In other words, investors were very benign with respect to credit. Anything that wanted to get finance could get finance. Give you an idea of how benign the markets were in 2007. 37% of the high-yield market that got financed that year were triple Cs. You have any idea what the expected default rate is on a triple C new issue for 3 or 5 years after issuance? Historically, over the last 40 years? Any guesses? Let's take the 5-year cumulative default rate on a triple C new issue. Do I have any guesses? How much? 30. Wow, you are a bear. That's great. Could we hold that bid for a moment? Does anybody think 30? 35, thank you. Do I hear 40? I always wanted to be an auctioneer. 40. Okay. Anybody think 50% besides this gentleman? 50%. 70%. Wow, that's quite a distribution. The answer is just under 50%. So you get the price. I don't know what it is yet. We'll have to figure that out. So 50% expected default rate on a triple C, and yet 37% of the new issues in 2000, I'll show you this, it's in a graph, in the high-yield market were triple Cs. We like to think that triple C new issuance is a great measure of liquidity. When it's easy to issue a triple C, liquidity is easy, plentiful. When it's really tough, and you can extend that to B minus or even Bs, then that's a good measure of liquidity in the risky debt market being tight. Well, we know that the spread went to 2,100 basis points in the great financial crisis just after Lehman Brothers, 2,100. It dropped a lot, mainly due to the central bank's activity and the stock market's recovery. And it dropped to around the historic average for many years since 2010. Here we were, February of this year, and this is the yield actually, that was the spread. In February of this year, the spread was 860 basis points. Historic average, 525. So we were about 300 plus basis points above the historic average in February of this year. That's when I thought we were in the 9th inning of the baseball game and the 90th minute of the football game. But, you know that old saying, this time it's different? I was on a panel last week, no, it was 2 weeks ago in Mexico with Carmen Reinhardt from Harvard, who wrote that book with Rogoff on this time it's different, and it is different. The role and aggressiveness of central banks has never been more important, dominating to some extent, and worrisome than it is today with respect to the expansion of debt in the world. And in February of this year, the 4 central banks all pumped enormous amount into the system, and instead of that spread going from 850 up to maybe 1,000 or even 2,000, which is, of course, the great crisis, it dropped. So why did it drop so much this year? And incidentally, I've got some egg on my face because, you know, I was saying we're in the 9th inning or the set 90th minute, which means that the game is just about over, and we are moving from the benign cycle into the stress cycle. And indeed, just the opposite happened. And returns have been spectacular. We underestimated the impact of 3 things happening at the same time. Fed activity, or central bank activity, price of oil, and China. All 3 moved in the, say, benign direction, and the spreads have come down. The last time we looked at it in the U.S. was 476. That was on the 28th of last month. I assume today the spreads will go up. We can all check that later, how much Trump's victory has impacted the spread. And I don't even know what it was yesterday, but we just checked the European spread as of the end of last week was about 370. U.S. 470. So we're about 100 basis points in the U.S. higher than Europe as we speak, or as of yesterday. Today, I really don't know. We can look at that. So we are no longer in a stressed potential with respect to the outlook from spreads. And finally, I'll skip over our forecast. Oh, by the way, here's the data for those of you who are interested on expected default rates given a rating at birth. And I'm not just saying this today because this conference is sponsored by Standard & Poor's or S&P Global, but the rating agencies do excellent work, particularly in the rating of new issue, plain vanilla bonds and loans. You might argue that over time that excellence is not always there in some of the, say, less data historic periods like structured finance, although I think that is getting much stronger as well. But when it comes to new issue, plain vanilla bonds and loans, which is the bread and butter of these agencies, they do a spectacular job on that original new issue. And therefore, we can use that, I believe, as the benchmark for subsequent default rates. And here is where, when I ask the question, about triple C, 47.4% is the historic incidence of triple C defaults by the fifth year, and about 34% by the third year. This data, by the way, is based on a methodology known as the mortality rate approach to default analysis. It's like an insurance actuarial approach based on contingent probabilities of survival up to a point in time. What's the probability of default going forward? And so we can go from the marginals to the cumulative, and that is going to be slightly different than the standard rating agency approach, but it's not all that dissimilar when you look at the results for 5 years. Any of the rating agencies, you can download Standard & Poor's matrix on cumulative default rates. You'll find triple C's being close to 50% for 5 years, and B's being, for example, 28%. And then you would adjust it for recoveries, and you could say that the typical investor in a single B, which is the dominant junk bond, can be expected to lose about 20% of their money by the fifth year from defaults. Well, 20% is a lot, but when you factor in the compound spread that you'll earn over 5 years, you can understand why that asset class can be attractive. Of course, the compound spread on a 6% spread compounded for 5 years is going to be much more than a 20% loss rate from defaults. And so you can argue that that is a good way of analyzing the market. Let me move on very quickly to talk about two other metrics and then finish up. Here's a question that I don't know if you've thought about. We've thought about it a lot, and I've thought about it certainly myself, probably more than anyone. 2007 versus now 2015, which is the latest data we have. This chart shows 2014. So here's the question. Is the average corporate credit quality, the probability of default, if you will, of corporate America, and you can extrapolate to corporate Europe, and particularly in the non-investment grade class, high yield, is it more risky, less risky, or about the same in 07 versus 2014? So let me put it more clearly. Is today's corporate credit profile more risky or less risky than it was in 07, or about the same? That's the question. So let's take a little vote. This is not asking you to, well, maybe it has some similarities, whether you like Trump or Clinton, but I don't think there's too much bias in this. How many think that today's corporate profile, based on profitability, cash flows, leverage, whatever variables you're interested in, is more risky today than it was in 2007? More risky. Raise your hand. Okay, we've got about 20. How many think less risky today? A little bit more. So it may be twice as much, 40. How many think about the same? A smaller number. Okay, well, we asked that same question. And we started asking this question a couple of years ago. And so how do we conclude? How do we know? Well, we can look at individual measures such as cash on the balance sheet, leverage ratios, profitability, cash flows, market value of equity, and depending on what type of model you like, you might not be surprised, we decided to look at Z-scores. So we looked at the Z-scores of the corporate population we can get data on back in 07, compared it to 2012 and 14, and now we're updating it for 15. And the results are, by the way, here is the old Z-score model, now 50 years old. Still going strong, by the way. Mr. Bloomberg tells us They get about 5,000 hits a day on Z-scores. I wish he was running for president. He would have been a great president. Maybe will be some, but he's not as old as I am, but he's getting on. And he's got a great service, but he's really cheap. And I don't get one penny from any of those hits. So there's a lot of unfairness in the world. But anyway, it's nice that 5,000 hits a day. Incidentally, the surprising thing about those 5,000 hits, more equity investors are interested than debt investors. At least that's what they tell me. So I was surprised with that. So here's the Z-score and its variables and coefficients. Here's something called Z double prime, which we built in 1995 to handle emerging market countries and non-manufacturing companies, but industrials. This is not for financials. This is something called bond rating equivalence. So you look at, for example, the average or median Z-score by rating, and you see this hierarchy. So any company with a score of 0 or less is in the default zone, and any score above 4 is in the AA or so. The AAAs are almost non-existent. There's only 3 AAA companies left in the US. I don't know if there are any in Europe. Are there any industrial companies rated AAA in Europe? Nobody knows? No. None. Okay. So we've got 3. We used to have 15 or 20. Bond rating equivalents. And here's the results of our study. A lot of numbers here. Top panels are the number of firms that we used, and now we're expanding to 215, and we get a little bit more, both in Z-score and Z double prime. Z-score, by the way, you need market value of equity. Here are the results. Median Z-score in 07, 1.8. Median Z-score in 14, 1.8. Z double prime, 4.6 and 4.56. Our conclusion, basically the same probability of default, 07 versus 14. So is that good news or bad news for the future? By the way, those of you who said about the same, you got it right, about the same. But is that good news or bad news? Well, you could argue, well, it's no worse, but it's no better. And if it's not better, let's look what happened in 08 and 09. Things weren't so good then in terms of defaults. So I think overall it's bad news. But let me give you a little preview of coming attractions. The 2015 results are improved. The Z-score has improved this year. We haven't published this yet. You're the first audience that I just saw the preliminary results from our assistant last week. And it looks like it's going up to maybe 2.1 average Z-score compared to 1.8 in 2014. So there are improvements on the line, which is better news, but it's still not great that it's better. Finally, there are a lot of other measures we're looking at. Let's talk about these new issues in triple Cs. A lot of data here. Let's look at this graph. This is new issue, Europe and the US, high-yield bonds. Notice these years, 2010, 11, 12, 13, 14, and this is for the first 9 months of 2016. All $200 to $300 billion of new issue high yield. Look at what it was back in 06 and 07. 05, 06, or 07 was, maybe half. So high yield has exploded as corporate debt has exploded, mainly to take advantage of low interest rates and liquidity in the market. The quest for yield on the demand side, and you have the corporates saying, wow, let me raise debt. Now, what are you going to do with that money? They're not making investments in real assets. So you buy back stock, add to the cash on the balance sheet, maybe, more in investment grade than non-investment grade, and you raise your leverage ratios dramatically. Well, there used to be a theory in corporate finance that maybe you've studied, and it has to do with the opportunistic theory of capital structure. You raise debt when interest rates are low, you raise equity when equity prices are high, and you have some sort of target capital structure. I believe in that, although some theorists say there's no such thing as a target capital structure that you aim for. But that assumes that the company, when it decides that the cost of debt is too high, either based on interest rates or how much debt they already have, and they say now it's time to go back and regress to the mean by issuing equity, that was easy to do when the correlation between debt and equity was 0.3 and 0.4. I'm talking about returns. Guess what the correlation is today, since 2008, between equity prices and debt prices? Close to 0.8. When you have a correlation that high, there's no place to hide. You cannot go back cheaply and say, okay, now I'm going to raise equity because our debt ratios are high. Well, you may be able to do it, but at real high costs of equity. And so I think the structural ability of companies to change from debt to equity is far more challenging today than it was, say, up until 2007. European data looks somewhat similar at a smaller level, although it is leveled off. Here's the CCC new issuance. 07, 37% of all high-yield bonds were CCCs. Now it's less, somewhere between 10 and 20%, so more conservative, but it was quite risky in 2012, 13, and 14. Those are the CCCs I'm worried about defaulting in 16, 17, and 18. And finally, let's talk about purchase price multiples on leveraged buyouts. This is data from Capital IQ, which I believe your platform is still called Capital IQ, so I can say that, even though the overall umbrella is slightly different name. And this data shows the purchase price multiples paid on leveraged buyouts being at a peak in 07 of 9.9 times when it comes to new LBOs and 9.1 times on secondary LBOs. Well, that was very high and very risky. And now it's even higher, to 10.9 in 15, 10.7 for the first 3 quarters of this year, and in the third quarter, a little lower. So 10.7 times cash flow to pay for a company, even if the leverage ratio is not as high as it was in the 1980s, but it's still maybe 65, 70%, meaning enormous amounts of debt in the private equity industry at pretty high debt to EBITDA ratios. Yes, the interest rate is lower, and maybe this time it's different. But this is troubling also for the future. So let me conclude. Default rates are above historic average. Recovery rates are much below. 2 elements in the reduction in the benign cycle. However, spreads are still pretty low, and liquidity is still pretty decent. So we're in extra innings, extra time, in my opinion. How long will the extra time last? It all depends on a lot of variables, which maybe we can pursue in the Q&A, and I'll wait for them to give you my opinion on it. How long will the extra time last, and how serious will be the ramifications of the benign cycle ending in the next stress cycle? With that, Martina, I will conclude, and thank you very much for your patience.